Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to discuss two very important articles of the Reserve Bank of India. The first one is regarding the Japan and India which have signed the bilateral swap arrangement. Now what is the limit of this bilateral swap arrangement? What is the meaning regarding this bilateral swap arrangement? How it happens? So all of this we are going to discuss in today's session. Okay. The second news article is regarding the RBI that has finalized the acquisition finance norms. So we'll discuss that what are the acquisition finance norms, as well as there are various data points that have been provided under this guideline, so that we are going to discuss. Okay, so the data points are very important from the examination point of view because the commercial banks, they are allowed to do the acquisition finance. So how the commercial banks and till what limit the commercial banks can do the acquisition finance, all of this we are going to discuss in today's session. As well as there is the discussion regarding the overseas syndicated deal that also we are going to discuss. So today's session is going to be important and I hope I'm clearly audible and the screen is visible. So give me a thumbs up if everything is fine. And good morning everyone. Good morning Ashutosh. Good morning Akshu. So welcome to the session everyone and let's get started. Okay, so before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so now we are going to start with the first news article that is regarding the renewal of the bilateral swap arrangement between Japan and India. This is effective from February 28, 2026. So I hope, yes, so I'm clearly audible. Now let's start with the first news article that is regarding your bilateral swap arrangement between India and Japan. Okay, so this is effective from February 28, 2026. So Bank of Japan acting as the agent for the Minister of Finance, Japan, and the Reserve Bank of India. So Bank of Japan and the Reserve Bank of India, they have signed the third amendment and restatement agreement of the bilateral swap arrangement. That means this bilateral swap arrangement between Japan and India, this is not something new. This has been going on since 2019. Okay, so this bilateral swap arrangement has been going on, but this has been renewed now. This has been renewed in 2026, and this renewed bilateral swap arrangement between Japan and India, this is effective from February 28, 2026. So what is this bilateral swap arrangement? First, let's understand this bilateral swap arrangement between India and Japan, then we will move forward with the other details. Okay, so through this example you can easily see bilateral swap arrangement between India and Japan. First of all, this is a financial agreement that helps both countries, support each other during financial stress. So the the bilateral swap arrangement, this is nothing else. This is an agreement that is signed between the India and Japan to support each other during financial stress. Now take an example, think about it, that if India is in a troublesome situation, if India is in a problematic situation where India requires dollars, immediate need of dollars is there. Okay, so if India requires dollars immediately, then this bilateral swap arrangement will come handy. Okay, so in this what will happen, that India and Japan having the bilateral swap arrangement, and India requires the dollars, let's say. So India will provide the rupees to Japan and Japan will provide the dollars to India. Okay, so this is the first leg of the arrangement, or this is the first leg of the transaction where the activation of swap is happening. India is saying that okay, we are in the financial stress and we require the dollars. So India will provide its rupees to Japan and Japan will provide the dollars to India. Now when the stable situation comes, now India is in the stable situation, so India, as the agreement ends, let's say after 3 months or after let's say 2 months, when the agreement ends, the India will take back its rupees and will give back the dollars with some interest to Japan. So I hope this is clear. So this is the idea, that if India is in the requirement, if India requires the dollars, then India, the Reserve Bank of India, can provide the rupees and can take the dollars. As we require the dollars, so we will take the dollars from Japan. Japan will provide us the dollars and in return we are giving them the rupees. Okay, now when the market stabilizes, the Reserve Bank of India is in, or the country is in the stable situation, the RBI will give back the dollars. With the interest, and we will take back our rupees. That is the idea. So this is like a emergency credit line. This is like a emergency credit line between India and Japan. Now, if Japan is in the problematic situation, if Japan requires the dollars, then Japan will provide us the yen. So if, let's take the other example. If let's say Japan is in the problematic situation or Japan requires immediate dollars, Japan requires $10 billion. So Japan will provide its yen to India and India will provide the $10 billion to Japan. Okay. Now, when the stable situation comes, or after 3 months, when the agreement ends, when the bilateral swap arrangement ends, so after 3 months, let's say Japan will return the dollars with some interest and we will give back the yen. Okay. Japan will return the dollars to India with interest and we will give back the yen to Japan. So this is the bilateral swap arrangement, and this is a two-way arrangement. That means India or Japan, both of these countries can take the benefit of this arrangement. So I hope the basic idea of the swap is clear. So the Bank of Japan, acting as the agent of the Minister of Finance of Japan and the Reserve Bank of India, have signed the third amendment and restatement agreement of the bilateral swap arrangement. The bilateral swap arrangement is a two-way arrangement. That means both the countries can take the benefit of this bilateral swap arrangement, where both countries can swap their local currencies for the dollars. So if India requires the dollars, we can give our rupees to take dollars from Japan. We can give our rupees to take dollars from Japan. Okay, but after the agreement ends, or let's say after 3 months or after 2 months, whatever is the timeline, we will have to return the dollars to Japan with some interest, and the Japan will return our rupees to us. Okay, so this is the swap arrangement. First step is the activation of the swap, where we are taking the dollars. Okay, and the second step is settlement, where we are returning the dollars with the interest. So the bilateral swap arrangement is a two-way arrangement where both the countries can take the benefit of the bilateral swap arrangement. It's not only that India will take the benefit, Japan, if it requires, it can also take the benefit of this bilateral swap arrangement. Okay, where we can swap our local currencies in exchange of the dollars from the other country. The size of the BSA. Now this is important, that the size of the bilateral swap arrangement remains unchanged, that is up to $75 billion. So we can take up to $75 billion from Japan in the case of emergency, and Japan in the case of emergency can take $75 billion from India. Okay, so this is the bilateral swap arrangement, can be up to $75 billion. So now why this arrangement has been signed? By, like, now you have understood this already, that the arrangement must have been signed for the cooperation between the countries in case of financial stress. So Japan and India believe that the bilateral swap arrangement, which aims to strengthen and complement other financial safety nets. So India can go to International Monetary Fund, India can go to the multilateral institutions in case of requirement if it requires the dollars. But there is this Japan-India bilateral swap arrangement. This is the additional safety net that India now has, or this is the additional safety net that Japan now has. Okay, so in case of any financial stress of turmoil, India can take the help of Japan. India can use the bilateral swap arrangement. So this is the idea. So this is the additional financial safety net that India and Japan both now have. This will further deepen financial cooperation between the two countries and contribute to regional and global financial stability. So rather than only relying on the International Monetary Fund, rather than only relying on certain facilities, now we have this additional bilateral swap arrangement. So any confusion, anyone? Okay, very good question. Exchange rate. So exchange rate can be decided during the agreement. So let's say the agreement has been signed. This is the agreement. There is the agreement that has been signed, that India is taking the $10 billion from Japan and India is giving its rupees to Japan. Okay, now this agreement is, let's say, for 3 months. So it can be decided that the exchange rate will be followed for the dollars the same as right now. Okay, so the same exchange rate that is right now will continue till the end of the agreement that ends after 3 months. So I hope this is clear, that so the countries do not lose. So that's why the exchange rate can be decided, can be pre-decided when the agreement is being signed, that okay, for 3 months India is taking the $10 billion and after 3 months India will return the $10 billion with the interest, with certain minimum interest rate, and Japan will return the rupees. So in this agreement, the exchange rate can be pre-decided, that okay, what is the exchange rate right now, that same exchange rate will continue. Okay, so this is the idea. Any other confusion? Interest rate will be in dollars. Chalo. So the agreement for bilateral swap arrangement between India and Japan, I told you that this agreement has been, this arrangement, bilateral swap arrangement, this has been renewed. This has been renewed. That means this is not a new arrangement that just started in 2026. No, not like that. So it may be recalled that the bilateral swap arrangement was negotiated between India and Japan during the visit of Prime Minister Shri Narendra Modi to Tokyo on 29th October 2018. Okay, so this discussion regarding the bilateral swap arrangement, it happened between the prime ministers of India and Japan, we can say, in 2018. This bilateral swap arrangement provides for India to access $75 billion, whereas the earlier bilateral swap arrangement had provided only $50 billion. Okay, the bilateral swap arrangement was approved by the Union Cabinet on 10th January 2019. So since 2019, you can understand, since 2019, the bilateral swap arrangement with the $75 billion is available to India and Japan, Okay, I hope this is clear. So this is not a new facility. This is not a new arrangement between India and Japan. This has been in effect since 2019, but it has been renewed in 2026, so that you have to remember, and the limit is $75 billion for the bilateral swap arrangement. I hope there is no confusion. Now moving forward to the next news article, that is regarding the RBI that has finalized the acquisition finance norms. So what is this acquisition finance? What are the data points? All of this we are going to discuss, and these norms are going to be in effect from April 1, 2026. Okay, so let's get started with the acquisition finance norms. But before that, we have to understand that what is acquisition finance. Then we will understand the acquisition finance framework. Okay, in the first news article, any confusion anyone has? In the first news article, any confusion? Anyone? Okay, now acquisition finance refers to a loan or financial assistance. So acquisition finance is basically a loan or the financial assistance the borrower is taking from the bank. Okay, so acquisition finance refers to a loan or financial assistance that is given to an eligible borrower. So here you can understand that a bank, a commercial bank, so it has been allowed that a commercial bank can provide the financial facility, can provide the loan to an eligible borrower entity. Now, who is the eligible borrower entity? That we will discuss in the coming slides. But basically, the commercial bank can provide loan, can provide the financial facility to a borrower entity that wants to acquire the target company. So this borrower company, it wants to acquire the target company. So basically, the commercial banks have been allowed to provide loan, to provide the finance to the borrower entity, to the acquiring company to acquire the target company, by purchasing the equity shares, by purchasing the shares of the company, or by purchasing the compulsory convertible debentures that convert into the shares. Okay, resulting in, if the acquiring company is taking the loan to buy the shares of the target company, to buy the compulsory convertible debentures that convert into shares of the target company. So basically, acquiring company is acquiring the shares, is taking the shares, buying the shares, the compulsory convertible debentures. So there is some control that is going in the hands of the acquiring company. So acquisition finance refers to a loan or financial assistance given to the eligible borrower entity for purchasing the equity shares, for purchasing the shares or compulsorily convertible debentures in a target company, so that there is some control that is taken by the acquiring company. Okay, there is some control that is coming in the hands of the acquiring company by purchasing the shares and the compulsory convertible debentures of the target company. Now, what is the objective of this kind of loan? What is the objective of this kind of acquisition finance? The objective is simple: by providing acquiring control over the target company. So if the borrower entity is taking the loan, there must be acquiring control that the borrower entity must have on the target company. So if the borrower entity is taking the loan from a commercial bank to acquire the target company, to buy the shares and compulsory convertible debentures of the target company, then the eligible borrower entity must have some acquiring control, must gain some acquiring control over the target company. Okay, so there must be some control. It's not like that the 100% of the company will be bought by the acquiring company, or it is not like that even 70% of the company will be bought by the acquiring company. No, maybe the acquiring company only has 26% of the control, but this is considered a substantial control. Even 51% of the control or 75% of the control is considered substantial control. So you can understand that the loan is being provided by a commercial bank to the borrower entity so that it can acquire a major control over the target company by buying the shares, by buying a major portion of the ownership, or by buying the compulsory convertible debentures in the target company. Any confusion? Yes, correct. So the basic idea is correct, that the acquisition finance is basically acquisition finance framework. It provides the conditions, it provides the norms, it provides the framework under which a company, the acquiring company, can acquire the target company by taking the loan from the commercial bank. Okay, so acquisition finance framework, it provides for the banks to provide the loan for the acquiring company to acquire the target company, and to acquire some control over the target company. This is the idea. So now, how you can acquire the control over the target company, how the acquiring company can acquire the control over the target company? By buying the shares of the target company or by buying the compulsory convertible debentures of the target company. Okay, so this is the basic idea. Now coming to the next point. Okay, just give me a second. Okay, acquisition finance may be extended by a commercial bank. So remember this, that acquisition finance is basically the loan or the financial assistance that is provided by the commercial bank to the borrower entity, to the eligible borrower entity. That is the acquiring company that wants to acquire the target company. Okay, so acquisition finance may be extended by a commercial bank. The loan can be given by a commercial bank to an Indian non-financial company, for acquiring equity stakes, for acquiring the stakes, shares, control, ownership in domestic or foreign companies as strategic investments. That means that the investment or the acquiring company, if it is acquiring the shares of the target company, that should be for a long-term period. Those investments which are driven by the core objective of long-term investment. So acquisition finance can only be provided to the acquiring company. The acquisition finance can only be provided to the acquiring company to acquire the control over the target company for a long period of time. So this should be a long-term investment. It should not be a short-term restructuring. Okay, so this is the idea, that the investment which are driven by the core objective, the acquiring company taking control over the target company, should be for the long-term objective, for the long-term value for the acquirer, for the acquiring company, through potential synergies rather than mere financial restructuring for short-term gains. So this kind of control should not be only for the short-term gains. It should be for the long-term value. It should be for creating the long-term value and potential. Okay, so this is the idea. Now coming to the next point. So eligible entities, which are the eligible entities that can have the acquisition finance, that can take the acquisition finance from the commercial banks? So non-financial entities, we have discussed that the acquiring company being a non-financial company can take the acquisition finance directly, or it can take the acquisition finance through its subsidiary, or it can take the acquisition finance through the special purpose vehicle. So the acquisition finance can be provided to the acquiring company directly. Let's say Tata Motors is acquiring XYZ company. Okay, so directly to the acquiring company, the loan can be provided, the acquisition finance can be provided. Or let's say Tata Motors is not taking the acquisition finance directly. There is some subsidiary of the Tata Motors, that is ABC is the subsidiary of the Tata Motors. Through this subsidiary, the acquisition finance is taken. Or the Tata Motors can have a special purpose vehicle. Special purpose vehicle is a special kind of subsidiary that is created for a special purpose. So a step down special purpose vehicle can be set up by the acquiring company for acquiring the target company, So acquisition finance did not compulsorily have to be taken by the acquiring company. The acquiring company can take the acquisition finance, but the subsidiary of the acquiring company can take the acquisition finance, or the special purpose vehicle that is created by the acquiring company can also take the acquisition finance to acquire the target company. I hope this is very much clear. Non-financial companies are basically that are in the automobile industry. That is not a bank, that is not a NBFC. So non-financial company is not a financial company, it is not a bank, it is not a NBFC and such. Okay, so non-financial companies are your clothing industries, clothing firms, your automobile industry, FMCG, all of this comes under the non-financial company. Okay, so acquiring company must be a non-financial company. The subsidiary, special purpose vehicle, they must be non-financial subsidiary or special purpose vehicle. Okay, so acquisition finance can be taken directly by the acquiring company to acquire the target company, or acquisition finance can be taken by the subsidiary of the acquiring company to acquire the target company, or the special purpose vehicle can be created by the acquiring company to acquire the target company. Okay, so this special purpose vehicle can take the acquisition finance to acquire the target company on behalf of the acquiring company. That is the idea. Okay, because acquiring company do not want to change its own book value, and it does not want to change its own book accounts and such. So acquiring company creates a special purpose vehicle to take the acquisition finance to acquire the target company. So this is the idea. Now, coming to the next part, that is acquisition finance shall be subject to following conditions. And first, we are starting with the financial criteria, that acquiring company must have certain basic financial criteria met. Okay, so that is the idea. So acquiring company, or where the acquisition is done through the special purpose vehicle or the subsidiary, so the acquiring company that is controlling such special purpose vehicle, or that is controlling the subsidiary, because as I have told you that the acquiring company can acquire the target company through a subsidiary or through a special purpose vehicle. So acquiring company must follow some financial criteria. The acquiring company must be completing some financial criteria. So acquiring company, or where the acquisition is through the subsidiary or the special purpose vehicle, the acquiring company controlling such SPV or subsidiary shall meet the financial criteria, shall meet these financial criteria. Now let's say the acquiring company is a listed entity that is listed on the stock exchanges, on the National Stock Exchange or the Bombay Stock Exchange. Okay, so Tata Motors, let's say it is a listed entity that is listed on the NSE or BSE. Okay, so for the listed entity, there should be some norms. So acquiring company that is borrowing, that is taking the acquisition finance, that is taking the loan, shall follow certain financial criteria. It should have the minimum net worth of 500 crores. It should have the minimum net worth of 500 crores, as well as the net profit after taxes. After deducting the taxes, the net profit reported in each of the previous 3 consecutive financial years. So in the previous 3 consecutive financial year, there should be net profit that the acquiring company is getting after taxes. So I hope this is clear, that the acquiring company that is taking the acquisition finance should follow these financial criteria. It should, if it is a listed entity, it should have a minimum net worth of 500 crores, as well as in the previous 3 consecutive financial year, it should have the net profit after taxes. Okay, that is the idea. Now remember that the acquisition finance can be taken by the acquiring company that is unlisted. It has not been listed, but there are certain norms that it has to follow. First of all, it should also have a minimum net worth of 500 crores, as well as it should also have the previous 3 consecutive financial year, it should have got the net profit after taxes. Okay, that means it should be a profitable entity that is acquiring the target company. So acquiring company that is unlisted will get the acquisition finance if it has the minimum net worth of 500 crores, as well as in the previous 3 consecutive financial years it has got the net profit after taxes, as well as there is another additional condition that it has to follow. The additional criteria for the unlisted entity is that the investment grade rating should be BBB minus or above from a credit rating agency. So this acquiring company that is unlisted should have got the rating of the investment grade rating of BBB minus or above from a credit rating agency. If there is no rating that is available for the acquiring company that is unlisted at the time of sanction of the acquisition finance, it shall be obtained. So rating has to be obtained before disbursing the acquisition finance, before disbursing the loan. So that is, I hope this is clear. Okay, of course, credit rating agency gives the rating, right? Credit rating agencies are the agencies that give these ratings. Chalo, now see, special purpose vehicle. So remember, special purpose vehicle So let's say this is a acquiring company. Acquiring company has a subsidiary. Okay, like the Reliance Industries has the subsidiary Geo Financial that is engaged in the financial domain. Okay, now this acquiring company, now financial companies are not allowed here. So let's take some other example. Let's say acquiring company is Tata Group. Okay, now it has a subsidiary that is Tata Motors that is working in the domain of automobiles. Okay, or the Tata Group can through the subsidiary acquire the target company, or it can create a special purpose vehicle that is a separate entity that is created only for the purpose of acquiring the target company. So special purpose vehicles, they are a subsidiary of the acquiring company, but they have a special purpose. That's why they are known as the special purpose vehicle. So special purpose vehicle is nothing else. It is a subsidiary, step down subsidiary of the acquiring company, but it has a special purpose. It is only created for the purpose of acquiring the target company, while the original subsidiaries of a group, the original subsidiaries of a company, they have certain other functions also. Okay, so that is the idea. I hope this is clear. So acquiring company, if it is listed, it must have a minimum net worth of 500 crores and net profit after taxes for the 3 consecutive financial year. In the case of unlisted entity, the same rules will be followed, but one additional criteria is the investment grade rating of BBB minus or above. Okay. Now moving forward with the next conditions, that is coming to the control conditions. So control acquisition requirement. So acquisition shall result in the acquirer. So as we have discussed it in the starting only, that if the acquisition finance is provided to the acquiring company must gain some control over the target company. Okay, so acquisition finance, the acquisition shall result in the acquirer obtaining control of the target company through a single transaction. Now the acquiring company might be taking control of the target company through a single transaction. In one transaction, 5 lakh rupees has been given, or 5 crore rupees has been given, where a big chunk of control is taken from the target company. Or the series of interconnected transactions can happen, that 5 crore rupees is given in the first leg, 10 crore rupees is given in the second leg, and 30 crore rupees is given in the third leg. So a series of interconnected transactions can happen through which the acquiring company is taking control of the target company. But this kind of acquisition should be completed within 12 months from the date of execution of the acquisition agreement. That means if the acquisition agreement has been formed on 1st of January 2026, by the end of the 12 months, the acquisition should be completed. So the acquisition should be completed. The acquisition should be completed within 12 months of signing the agreement. That is the basic idea. Okay, so acquisition shall result in the acquirer obtaining control of the target company through a single transaction. The money can be given, or through a series of interconnected transactions the control can be taken, but this kind of transaction should be completed within 12 months from the date of execution of the acquisition agreement. Okay, now remember one thing. Let's say the acquiring company, that is Tata Motors, already have 10% of shares in the target company, okay, or 15% of the shares in the target company. This is a research and development company that is doing the research in the automobile industry. Okay, so now the acquiring company, that is Tata Motors, already has 10 to 15% of shares of the target company. That means it already has a good control, because 10 to 15% of shares in a company means a good control over that company, a good kind of rights or voting power in that company. So it already has some leverage, it already has some control over the target company. Now if it wants to increase the control, and the acquiring company is taking the acquisition finance to increase its control, to increase its acquisition of the target company, so it is allowed. That means acquisition finance is allowed for the acquiring company to increase its control in a target company, but there are certain guidelines that has to be followed. That means where the acquiring company already holds control over the target company, already has a good shares in the target company, acquisition finance may be extended. Acquisition finance can be given by the commercial bank only when the additional stakes are crossing a substantial threshold of 26% or 51% or 75% or 90%. That means if the acquiring company has 15% of the control in the target company, 15% of shares in the target company, so acquisition finance can only be provided to the acquiring company if it wants to increase its control to 26% or 51% or 75% or 90%. So that is the idea. Okay. So this is the basic idea. Any confusion here? So so where the acquiring company already holds control over the target company, has let's say 15% of shares in the target company, that means has a good chunk of control and power in the target company, has good chunk of voting power in the target company, acquisition finance can be provided by the commercial bank to the acquiring company to have more control over the target company when a substantial threshold is being crossed of 26% of the voting power or 51% of the voting power or 75% or 90% of the voting rights, so that there is enhanced governance or control rights that is given. Okay, so this is the idea. 26% of the shares basically of the voting power. I hope this is clear. Yes, 26%. See, 26% provides a veto power where the acquiring company, if the acquiring company has 26% of the voting power, it provides a veto to the company to block certain resolutions. 51% of the shares or 51% of voting power provides more power to the acquiring company. Okay, 75% of the voting power provides the power to the acquiring company to change the name of the company itself, to make major changes in the company. So you can understand that these are the substantial threshold: 26% of the shares, 26% of the ownership, 51% of the ownership, 75% of the ownership, or 90%. So if acquiring company had 10% of ownership, 10% of shares in the target company, if it wants to increase its control, acquisition finance can be provided if the control is being increased above 26% or 51% or 75% or 90%. That is the idea. Chalo, moving forward with the next point, that is related party restriction. Now, acquisition finance cannot be provided in case of related party transaction. Related party transaction means that in the same group, let's say Reliance Group or Reliance Industries want to have, Reliance Industries right now have 51% of the shares of Reliance Power. Now it wants to, Reliance Industry wants to have 75% of shares in the Reliance Power. So acquisition finance should be allowed because the control is increasing. But remember that there is a restriction that in the related parties, that is within the group itself, the acquisition finance cannot be provided, because within the group, if you are changing the control and such, that doesn't matter much because you already have a lot of control. And within the group, if you are changing the structure, that is short-term restructuring that you are doing. You're just changing the board members. You're just within the group, you're just doing the basic changes. Okay, so this is internal restructuring that is happening. This is not benefiting the economy a lot. So that is the idea. So related party transactions or related party acquisition finance is not allowed. The acquiring company and the target company shall not be related parties. Where related party means that there are two conditions of the related parties. First is that the entities that have relationship, such as holding or subsidiary relationship, or associate companies. Reliance Industry or let's say Reliance Power, Reliance Telecom, they are associate companies, let's say. Okay, so in case the holding subsidiary relationship, associate companies relationship, a firm in which the director or the manager or its relative is a partner, so the Reliance Power has the director or the manager who are the relatives of the director or managers in the Reliance Telecom. So that means there is some kind of relationship that is already present in between the companies. Okay, common directors, Reliance Power and Reliance Telecom have common directors. Let's say key managerial personal relationship is there. Common key managerial personnel are there. CEO or CFO, or let's say the board of directors are common in the Reliance Power and Reliance Telecom. In this kind of situation where there is the related party, the acquisition finance cannot be provided. As well as related party also means that entities, if they are under the control, they are under the management, or they have the common promoter group, where whether indirectly or directly. So in this case also the acquisition finance cannot be provided. So the acquiring company and the target company, they shall not be related parties. They should not have the holding subsidiary relationship or associate companies relationship or the common directors, common key manager person. They should not have the common management or the common promoter group and such. So in this kind of situation, acquisition finance cannot be provided if there is some related party transaction that is happening. Acquisition finance cannot be provided. Okay, now coming to the next point, that is financing parameters. Okay, till now any confusion? So financial financing parameters, the credit assessment shall be conducted. The credit assessment shall be conducted on a consolidated basis. What does this mean? So banks evaluate the combined financial situation, okay, financial strength of the acquiring company and the target company, because once the acquiring company has the control or has a major acquisition of the target company, you can understand that the acquiring company has 51% of the stakes in the target company, or the acquiring company has 75% of the stakes in the target company. So the target company financial strength also affect the financial situation of the acquiring company. So when the bank is evaluating that acquisition finance or the loan of 30 crore rupees should be given to the acquiring company or not. So in this case, when the acquisition finance or the loan is being provided, the bank has to evaluate the combined strength of the acquiring company and the target company, that once the acquiring company gain the shares of the target company, after that will the acquiring company be able to pay the debt comfortably or not. So that is the basic idea, that the bank should check whether the acquiring company, after taking the acquisition, will it have the same position to return the loan or not. Maybe after taking over the target company, the acquiring company will have a lot of different kind of debt situation. So acquiring company might go like for the short period of time, acquiring company might not be able to return the debt and such. So the bank has to evaluate the combined financial strength of the acquiring company and the target company, so that it can see that the acquiring company, after acquiring the target company, after taking over the control of the target company, will the acquiring company be able to return the debt or not. Okay. So credit assessment shall be conducted on a consolidated basis, incorporating the financial strength of both the acquiring and the target entities, and the bank has to see whether the acquiring company will be able to return the debt in a comfortable manner or not. Total bank financing. Now the acquisition finance. See, the acquiring company needs 30 crore rupees to acquire, or the acquiring company needs 100 crore rupees to acquire the target company. Out of this 100 crore rupees, acquisition finance can be maximum 75 crore rupees, that means 75%. So if the acquisition agreement is of 100 crores, the acquisition agreement is of 100 crores, through the 100 crores, the acquiring company can acquire 75% of control of the target company. So acquiring company wants to have 75% of control of the target company, and the acquisition agreement is of 100 crores. Now acquiring company can take the acquisition finance of maximum 75%. Okay, while see, if the acquiring company wants to take 51% of the control of the target company, then also acquisition finance is 75%. So acquisition finance, the total loan that can be provided is up to 75%, should not exceed 75% of the acquisition value. So that is the idea. Any confusion? So basically, the acquiring company, if it is acquiring 51% of stakes in the target company, that means it wants to have the major control of the target company, and the acquisition agreement is of 100 crores. The maximum acquisition finance that can be provided is up to 75%, that is 75 crores. The rest of the money, that is 25% of the money, that is 25 crores, should come from the own sources of the acquiring company. Okay, so 25% of the acquisition agreement money, 25% of the funds should come from the funds of the acquiring company. That is the idea. Okay, now remember this, that if the listed company, if the acquiring company is a listed company, the valuation, and the target company is a listed company, so as independently assessed. Now acquisition value, how the acquisition value is decided, that the acquisition value is 100 crores or the acquisition agreement is of 100 crores and this is the correct value of the company, of the target company. So how this value is determined? So basically the target company, if it is a listed company, the valuation of the target company shall be determined by one independent valuer to be appointed by the bank for valuing the shares which are not frequently traded. Because you can understand that the target company, if acquiring company has to acquire the target company, how the value of the target company is going to be decided? That if the acquiring company is having 51% of shares in the target company, if the acquiring company wants to have a major control of the target company and wants to buy major shares in the target company, so how the value of the target company is going to be decided? It can be decided on the basis of the share value in the market, right? But let's say that the shares of this target company are not frequently traded and that's why the market price is not accurate for the target company. That's why in this case, for valuing the shares, if the shares are not frequently traded, in this case one independent valuer is appointed to value the target company, to value the shares of the target company. So this is the idea, okay? In the case of unlisted company, where the target company is not listed basically, so that means the share value is not decided on the basis of the market, the shares are not traded on the market, so its value is not determined on the market, on the NSE or BSE. So here in the case of target company being the unlisted company, there should be the two independent valuers that has to be appointed by the bank for valuing the shares which are not traded at all in the market, because these are unlisted companies, so their shares are not traded in the market. Okay, so this is the idea, that if the target is a listed company, its shares are not frequently traded. The target is a listed company, but its shares are not traded frequently in the stock exchanges. In this case, the acquisition value cannot be based simply on the market price. The bank must appoint one independent valuer so that the valuer can determine the fair value of the shares, and the bank can provide the loan on the basis of the fair value of the shares. Okay, in the case of unlisted company, that is not traded on the stock exchanges, in this case two independent valuers have to be hired for the fair value of the shares to be identified. I hope this is clear. So this is the idea. Credit assessment shall be conducted on the consolidated basis, that after the acquiring company acquires a major control over the target company, the acquiring company, will it have the strength to pay back the debt that it has taken under the acquisition finance. Okay, total bank financing can be 75% of the acquisition value, and how the acquisition value will be decided? On the basis of the valuation that is done by the one independent valuer or two independent valuer, depending upon the listed company or unlisted company. Okay, so 75% of the acquisition value can be provided by the bank under the acquisition finance to the acquiring company, and the acquisition value is decided on the basis of the independent valuer in case the shares are not frequently traded, or in case the company is unlisted company. Okay, now coming to the next point, that 25%, 75% of the acquisition value can be provided by the commercial bank. So up to 75% of the acquisition value can be provided by the commercial bank to the acquiring company, but 25% of the acquisition value should come from the acquiring company itself, from its own fund. So acquiring company must contribute at least 25%, that is the remaining amount, or let's say the bank is only providing 60%. Because 75% is the maximum that the bank can provide of the acquisition value. So bank is not providing 75%, bank let's say is only providing 60%. So the rest 40% should come from the acquiring company own funds. Okay, so acquiring company must contribute the remaining amount from its own fund, from the internal profit amount that it has, or the amount that it has, or from the fresh equity, that is by selling its own shares to get the money to acquire the target company. Okay, this is the idea. So basically the bank can provide maximum up to 75% of the acquisition value to the acquiring company, and rest should come from the company itself. The bank can provide lower than the 75%. 75% is the maximum. So acquiring company must contribute the remaining amount from its own fund, from the internal accruals, from its own net profits that it has, or from the fresh equity that it is selling. Okay, next point is that the corporate guarantee from the acquiring bank has to be provided. What does this mean? So try to see this image. Let's take this example, and through that you will understand this point. Okay, so acquiring company, let's say this is the XYZ company that wants to acquire the target company, that is the company B. So company A, let's say company A is the acquiring company, company B is the target company. So company A wants to acquire the target company, that is company B. So now it has been identified that 1000 crore is the acquisition value. 1000 crore is the acquisition value. This has been identified because the target company is not traded frequently. It is a listed company. It is a listed company, but it is not traded frequently on the stock exchanges. So that's why there was how many valuers that were hired? One valuer has to be hired by the bank to identify the acquisition value, because in case of the listed entity, in case of the listed target company, the valuation has to be determined by one independent valuer appointed by the bank for valuing shares that are not frequently traded. So remember this, that in the case of company B, that is the target company, if it is listed on the stock exchanges but it is not traded frequently, so one independent valuer has to be hired by the bank to identify the acquisition value, okay. So now acquisition value has been identified to be 1000 crore. So 1000 crore is the acquisition value. What is the maximum that the bank can provide? The 75% of the acquisition value, this is the maximum that the bank can provide. So bank can provide maximum 750 crore loan, and the rest, that is 250 crore, should come from the acquiring company own funds. It can be the net profits that the acquiring company has, or by selling its equity it can get the 250 crores. Okay, now acquiring company is not acquiring the target company itself. It is acquiring the target company through a special purpose vehicle that is created for acquiring the target company. So I hope this is very much clear that the acquisition value is 1000 crore. The bank can provide the acquisition finance maximum of 75%, that is 750 crore. The acquiring company must have its own funds of at least 25%. Okay. Now, the acquiring company through the special purpose vehicle is acquiring the target company. In this case, the special purpose vehicle is a new subsidiary. It is just created for the purpose of acquiring the target company. It does not have its own major funds. It does not have its own major assets. It does not have a history. It is just created for acquiring the target company. So can the bank trust this special purpose vehicle? Blindly can we trust the special purpose vehicle? What if the special purpose vehicle is not able to give back the loan? Because the special purpose vehicle is acquiring the target company on behalf of the acquiring company, the special purpose vehicle is taking the loan, is taking the money to acquire the target company. But what if the special purpose vehicle says that, okay, I'm not able to pay back the loan. We do not have the funds to pay back the loan, and the special purpose vehicle is newly created. It does not even have the assets or history. So banks cannot trust the special purpose vehicle. So that's why a corporate guarantee has to be given from the acquiring company or its parent or the group holding entity. This shall be mandatory, because we cannot trust a subsidiary of the acquiring company. We cannot trust the special purpose vehicle of the acquiring company. The acquiring company has to provide its own guarantee that if the special purpose vehicle fail to pay the loan, then the acquiring company and its asset will be used to pay the loan. I hope this is clear. Yes, correct. Guarantee has to be given from the parent company or from the acquiring company, major acquiring company. Okay, because its net worth that was looked upon, it was the profit that was of the acquiring company that was seen before giving the loan. So acquiring company should give the corporate guarantee. Okay, after the acquisition, debt to equity ratio of the acquiring company, consolidated balance sheet. Consolidated balance sheet means that after acquiring the target company, its consolidated balance sheet level shall not exceed 3:1. Okay, so this is the idea. Just a second. So basically, debt to equity. Debt, how much debt the company has taken, how much is the equity value of the company, basically debt to equity ratio. How much fund has been raised through the equity. So debt to equity ratio should not exceed 3:1. So if the debt is 100 crores or debt is 300 crores, equity value should be 100 crores. Okay, so that is the idea, that after the acquisition has been happened, after the acquiring company has acquired a major chunk of the target company, the consolidated balance sheet, in the consolidated balance sheet, the debt to equity ratio should not exceed 3:1 on a continuous basis. So debt to equity ratio should not exceed 3:1 of the acquiring company's consolidated balance sheet after doing the acquisition. I hope this is clear. I hope this is very much clear. Any confusion? Any confusion? Debt to equity. How much debt the company has taken? How much is... Any confusion, anyone? Now coming to the last few points. Now coming to the bridge finance. Okay. While the acquiring company, if listed, the acquiring company, if it is listed, the acquiring company, if it is listed, may utilize bridge finance. Now we have discussed that up to 75% of the acquisition value can be provided by the bank. 25% of the acquisition value has to be brought by the acquiring company from its own funds or by selling its own shares or by selling its own asset. Okay. Now, what if the acquiring company is saying that it does not have immediate funds to provide for the acquisition? Out of the 1000 crore, it has got 750 crores from the bank. Now 250 crores, the acquiring company is saying that, okay, for the acquisition of the target company, we don't have the immediate funds of 250 crores. So here comes the idea of the bridge finance. Bridge finance means the financing a borrower, providing loan to the borrower for an interim period, for a short period, not exceeding 1 year, for a legitimate business purpose. So this is a legitimate business purpose that the acquiring company wants to acquire the target company to expand its business, to expand its profitability and such. Okay, where the borrower has a firm plan. The borrower in this bridge finance, the borrower, that is the acquiring company here, should have a firm plan and capability to repay such loans by raising the financial resources. So what does this mean? This basically means that while the acquiring company, if listed, may utilize, if it is listed acquiring company, that means it is a established acquiring company, it can utilize bridge finance to satisfy the minimum own fund requirement of 25%. Acquisition finance in such cases shall be subject to these conditions. Clear repayment plan there should be. There should be a clear repayment plan. If the bridge finance has been taken for the 25%, that should have come from your own funds. So if a bridge finance, that is a short-term loan, is taken for this 25%, so a clear repayment plan should be there. There must be a clear source to repay the bridge loan, such as issuing the new shares in 2 months, 3 months. So it has to be notified that in the coming 3 months, 10%, 5%, and 3%. In this manner, the shares will be released for the public. Okay, and this must happen within 12 months. Within 12 months, there should be the repayment of the bridge loan. So this is the idea, that the acquiring company, if it does not have 25% of the acquisition value immediately to acquire the target company, it can utilize the bridge finance. It can utilize the bridge finance, that is for a period of up to 1 year. 12 months. Within 12 months, the loan has to be repaid. Okay. Now, for taking the bridge finance, the clear repayment plan should be there. There must be a clear source to repay the bridge loan, issuing new shares. So the plan has to be shown that in what manner the new shares will be issued of the acquiring company to get the money to repay the bridge loan or selling the assets. This must happen within 12 months because bridge finance can be up to 1 year only. If a bank provides the bridge loan, it must be secured with the collateral. It must be secured with some additional collateral. Now, think about it. The bank is providing acquisition finance to the acquiring company up to 75%. So there is some collateral that is given by the acquiring company to the bank for providing the acquisition finance for providing the loan. So bank is providing loan to the acquiring company to acquire the target company, So the collateral is given by the acquiring company to the bank. So should the same collateral be used for the bridge finance? Should the same collateral be used for the bridge finance? No, right? So bank has to get a new collateral for the bridge loan. Okay, so if a bank provides the bridge loan, it must be secured with collateral. And remember that the bridge finance should not result in decrease or dilution of security coverage under the acquisition finance. Under the acquisition finance, the collateral shall not be diluted. The collateral shall not be used that is gone for the acquisition finance. That is the idea. Okay. I hope this is clear. So now we have discussed that the bridge finance can be provided that has to be returned in 12 months. There should be a clear plan for repayment. Now acquisition finance shall be, yes, debt to equity ratio is basically the debt of the company in its book divided by the equity of the shareholders, the equity or the share value that has been raised. Okay, that is debt to equity ratio that we have to see for the acquiring company's consolidated balance sheet after it has done the acquisition. Now acquisition finance shall be secured by the acquisition. Now security for the acquisition finance, what should be the security? So basically think about it, that the loan is given to the acquiring company to acquire the shares, that is the ownership in the target company. Acquire the shares or compulsory convertible debentures that convert into shares in the target company. So these equity shares or these compulsorily convertible debentures that is bought through the loan, they should be collateral that has to be kept with the bank. Okay, as well as additional collateral also has to be provided by the acquiring company. So acquiring company, if it is taking loans to buy the shares, those same shares will be collateral, as well as additional collateral also has to be provided by the acquiring company. So acquisition finance shall be secured by the acquired equity shares or compulsorily convertible debentures of the target company. So the same shares, the same compulsory convertible debentures will become the collateral for the acquisition finance. Other assets also has to be provided by the acquirer, by the acquiring company or the target company. The asset has to be provided to the bank. Okay, it can be any other additional asset that is provided as collateral. Now acquisition finance undertaken by overseas. Now we have the Union Bank, we have the Punjab National Bank, we have the multiple banks in India, we have the Bank of India. Let's say they have foreign branches, they have overseas branches. Okay, so acquisition finance undertaken by the overseas branches of Indian banks as part of syndication. So basically acquisition finance can also be undertaken by overseas branches of Indian banks. That is, foreign branches of Indian banks can also do the acquisition finance as part of syndication arrangement, as part of syndicate arrangement. In the syndicate arrangement, there are a group of lenders that are coming together to provide the loan to a company, and a single agreement is formed, a credit agreement is formed where the company has to return the money of the lenders. Okay, in this agreement all the terms and conditions are written. So syndication agreement or syndication arrangement, it is basically the group of lenders, they are jointly lending to a company or to a single borrower under a shared agreement, So this is the idea, the syndication arrangement, group of lenders, they are lending to a single borrower under a single arrangement. Okay, so acquisition finance undertaken by overseas branches of Indian banks as part of syndication arrangement shall not be subject to the directions that we have discussed above. So the limits and the directions will not be applied. The funding contribution by the overseas branch of the Indian bank should be limited to 20%. Okay, should be limited to 20%. Then the above guidelines will not follow for the acquisition finance undertaken by the overseas branches of the Indian bank. So this is the idea. Acquisition finance can be undertaken by the overseas branches of the Indian bank as part of the syndication arrangement where there are a group of lenders. In this kind of acquisition finance by the overseas branches of the Indian bank, the funding contribution by the Indian overseas branch should not increase 20%. Of the total funding under the deal. Indian overseas bank branch can only provide 20% in the syndication arrangement. I hope this is clear. Now coming to the last part, that is summary. Any confusion? No, Akshu, that is a guarantee is only a guarantee. It is not considered a collateral. Okay, collateral is different. Collateral is your shares or compulsory convertible debentures or your asset that you have, your building, factory that you have. Okay, that is some physical asset or financial asset. Okay, that is collateral. Guarantee is just a guarantee that the company has to give, that if the loan is not paid back by the special purpose vehicle, if the loan is not paid back by the subsidiary, then the guarantee will be used of the acquiring company. Okay, that is the idea. I hope this is clear. Now, acquisition financing by banks, commercial banks. Banks' participation in overseas syndicated acquisition finance is allowed, but it is capped at 20%. In the draft norms, it was said that this will be capped at 10%, but in the final directions, it has been said that 20% is the limit of the acquisition finance that can be given by the overseas bank branch of India in the syndication deal. Okay, in the syndication deal. So this is the idea. Now, so in the acquisition finance deal that is happening in the foreign, that is acquisition finance deal, the overseas Indian bank branch can provide up to 20% in the syndicate arrangement, in the syndicate acquisition financing. Okay, acquisition financing allowed only for strategic long-term investment, not for the short-term restructuring, and the related party transactions are also not allowed. The related party acquisition is also not allowed under the acquisition finance. So basically the banks, like related party acquisition can happen, but the banks, they cannot provide the acquisition finance for the related party acquisition. Okay, so banks cannot provide the acquisition finance. The banks cannot provide the acquisition finance for the related party acquisition. So this is the restriction of the related party. Okay, so acquisition financing allowed only for the strategic long-term investment, and the acquisition financing is not allowed for the related party acquisition. Banks must frame a board approved policy. Bank funding is capped at 75% of the acquisition value, while the acquirer company should have its own funds of 25%. And in this case, if there is a listed target company, one valuer should be there, one independent valuer hired by the bank should be there to identify the acquisition value if the shares are not traded much of the listed company. Okay, if there is an unlisted trading company that is not listed, that does not have the market value of the shares, it is not listed, it is not traded on the stock exchanges, so in this case the bank must hire two independent valuers that will value and that will identify the acquisition value. Okay, loans must be secured by the acquired shares or the convertible debentures with additional collateral permitted. Additional collateral can also be taken by the bank from the acquiring company. Bridge financing allowed for equity contribution with repayment within 12 months. So bridge finance is allowed for the self part, and 12 months is the timeline in which the return has to be done. Norms effective April 1, 2026. Existing loans allowed till maturity. Post acquisition debt to equity ratio should not increase to 3 to 1. 3 to 1. Okay, so it should not increase 3 to 1. So this is the idea. Borrowers must meet 500 crore net worth criteria. Now, coming to this, so see, the acquisition finance norms or the acquisition finance framework, this is part of the detailed framework that is released by the Reserve Bank of India under the Reserve Bank of India Commercial Banks Credit Facilities Amendment Direction 2026. Okay, so this is the idea that the RBI has released the Reserve Bank of India Commercial Bank Credit Facility Amendment Direction 2026. In this, there are three different criterias or three different norms that have been released. So under this, the RBI has released loan against eligible securities, lending to capital market intermediaries, and acquisition finance norms that is allowed for the commercial banks. So this loans against eligible securities by the commercial bank, lending to capital market intermediaries by the commercial bank, this we have discussed in a previous session. Now we have also completed the acquisition finance norms that is a part of the broader guidelines. Okay, the above amendments, all these amendments, they shall come into force from 1st April 2026 or an earlier date as adopted by the bank. Okay, now coming to the first question, I hope you will be easily able to answer this question. If there is any confusion, kindly ask me. Chalo, thank you everyone. Thank you for joining. This is the first question. I hope you will be easily able to answer the question. Do answer the question in the comment section below, and whoever gives the right answer, I will reply in the comment that okay, this is the right answer. Okay, now this is the second question. I hope you will be easily able to answer this question also, so do try to answer this question. Okay, so this is your second question, where you have to inform that regarding the RBI guidelines on acquisition finance, consider the following statements, and which of the statements given above is or are incorrect. That is the question. So this is it. Thank you everyone. Thank you for joining the session. I hope you enjoyed the session. I hope you got the points. If there is any confusion, you can ask in the comment section below. Do give the right answer of the homework question. See you in the next session. Thank you everyone.